Hello and welcome to another episode of The Unlocked Investor. I'm your host, Ian Robertson, and today I'm honored to be joined by Sean Tepper. He's the founder of Tykr, an investment research platform that helps people confidently invest in the stock market. Sean, welcome.
Ian, thanks for the invite. Good to be here.
Yeah, happy to have you. Before we dive deep into the many different facets that we're going to go into here, I would love it if you would just share what Tykr is and sort
Sure.
of how it helps people.
Sure. So Tykr is a analytics and educational tool all in one. So we're not a broker, but we do partner with brokers. And what that essentially means is broker is where you connect your bank account and you can buy and sell stocks. Well, what we do is we let people know exactly what stocks to buy and what to sell, when to buy, when to sell, and everything in between, like how to reduce risk of losing money. So you could literally look up NVIDIA or Palantir or Apple, and within seconds, you will know, is this something I should invest in or something I should avoid? And we've got, for context here, we've got like 50,000 stocks, over 1,000 ETFs, and we've got customers in like over 12,000 customers in about 50 countries. So they use this tool to really be their guide on their journey to investing on their own.
I love it. And now the words that you're using to describe it with analytics and things like that, like I know just firsthand that most people don't feel comfortable or confident in any capacity with investing. They just will put it into somebody else's hands, or
Mm-hmm.
they'll do something that their friend told them to do, and that's about the extent of their knowledge and their understanding. So, like, is it? I'm sure you're going to say it's user friendly, but like, is it something that that anybody can use or should use, or is this more geared towards like those high IQ investment nerds?
No. Well, I'm biased, but of course, I always tell people don't even listen to me. Go to our Trustpilot, see what our customers have to say. And we do, not bragging here, but we do have the highest Trustpilot rating in our industry at a 4.7 out of 5. But long story short, like when I created Tykr, I wanted to come up with a rating system that everybody really understands. And I was thinking, okay, so what is something people know and understand? And I thought of the traffic light. Doesn't matter what country you're located in or what language you speak, everybody kind of understands the whole green, yellow, red methodology. So our version of that is stocks and Tykr really roll up to on sale, watch, or overpriced. On sale is green, watch is gray, and then overpriced is red. And only about 15% of stocks actually make it to on sale. So it's a very rigorous algorithm that was created. So long story short, you could literally log in, and if you can read a traffic light, you can use Tykr. I'll put it that way.
Love it, love it. So this Tykr's been around a little while. We'll get back to more of the like
Mm-hmm.
details on investing, but can you just give a brief overview of how Tykr started, like what that
Sure.
initial journey looked like? The thought came in your head. How long from that thought to actually creating something and starting to use it?
You got it. So I won't spend too much time here. I'll try to take like 2 minutes or so. So my background is about 20 years in tech, 15 years in investing. Now I did not figure this out. Like I did not come out of the gates like, hey, I found the magic formula here. It took a lot of trial and error. So I built my first business from 2006 to 2010. I was just an agency building software and websites for small and mid-sized businesses. Went through a merger in 2010. And that's when I said, hey, I need to figure out a way to get money working for me as opposed to me working for money. An agency model, if you don't know, it's very labor intensive. You're building software, trading a time for a paycheck. So that's when I started investing. And it was really between 2010 and 2015. I was kind of investing blind. I was looking at different resources online, YouTube, reading a few books, but I was at best keeping up with the market, keeping up with the S&P 500. And to me, that was unacceptable. I'm like, I know guys like Warren Buffett, even Warren Buffett has said if he were managing 10 million or less, he could make 50% per year or more. I thought, wow, that's quite a bold statement. And I knew that him and the late Charlie Munger have, or these guys are not gambling men. They don't use feelings or emotions to pick stocks, which tells me my software engineering background says, well, they're probably starting with some sort of logic here, which means they're starting with math. And I found that to be true. So I went on the rabbit hole. Everything related to Warren Buffett I watched on YouTube, read as many books as I could. There's a lot of noise out there. And then I found a guy by the name of Phil Town that did provide some of the calculus for how to analyze stocks. So I took that out of his books, put it into Excel, and I kind of created at that moment, it was around 2015 or 16, I created the whole on sale, watch over price methodology and a scoring system. And there's a few other indicators as well. And I used that on my own. I'm like, okay, I want to use this, see if it really works. And the first year I made 15%. I was like, okay, great. The second year I made a little more than that. And I decided to get rid of all my funds, all my index funds and ETFs, because they were simply holding me back. And that next year I went to 80%, but that happened to be what I would call Trump tariff war one, when he did the first tariff negotiation. So the market did a big pullback. And as I learned from Warren Buffett and Phil Town, is you want to buy them when the market's going down. So anyway, I use this Excel sheet, making returns typically between 15 and 50%. 2019, I start sharing it with a few retail investors as well as a few financial advisors. And everybody was like, hey, you should turn this into a software so everybody can use it. And I was like, all right, green light. I always wanted to create a SaaS product, software as a service subscription product. So I'm like, let's do this. It took about a year to build the first version. We went live in 20. Then it took 6 months to get the first paying customer, but that's how it goes with building software. You just want to get people on for free and in return get their feedback. So you turn it into a tool they're actually going to pay for. And then, fast forward to today, we've got over 12,000 customers, going on 13,000 as of this week, in about 50 countries.
That's really exciting. Then I guess I'm just like sort of all over the place in my thinking right now, but because I want to expand on the story that you just laid out.
Mm-hmm.
But I'm thinking, you're saying these years, year one, I made 15%, year two, year three,
Yep.
you're making more and more, you're doing a better job just as you're learning and as you're growing. But inevitably there's down years, and inevitably, something unpredicted will happen. Much like right now, if you look at the stock market,
Yep.
like there's a lot of maybe unpredictability or at least uncertainty that's adjusting things. So can you speak to those things that maybe you can't expect in the future, and also like sort of the time horizon that you would normally be thinking about when you're making these investments based on your process?
Yeah, so we'll kind of zoom out for a second and then drill into a strategy that's really probably what I would consider the number one most important strategy. We'll get to that in a second, but I did a little homework, did a little analysis on bear markets, and get this, over the last 100 years, there have only been 17 bear markets or recessions with an average duration of about 10 months. What that tells us is when the market goes down, it doesn't go down for long. And that is historically true. The longest was of course, because you're in the space, the Great Depression, 1929 through just after 1940. World War II brought us out of that. Well, there are 4 key laws put into place at that point. I studied for the Series 65 to know the ins and outs of the laws. Riveting material, but I never went forward with the getting registered with SEC because we're a publisher exclusion. I won't talk about that too much, but we can't tell, long story short, we can't tell people or give them personalized financial advice. So that's really the rule. Anyway, those 4 rules or laws were put into place. I'll just give you one. It's the securities law of 1933. All right, there's one. But anyway, these laws prevent us from ever really running into a deep, long recession or depression ever again. There's not a 100% guarantee, but it's really prevented us from running into a similar situation. The worst was probably the dot-com bubble, going out, almost 60 years later. And then the next one would be the Great Depression of 2008, which was only 9 months. But anyway, the strategy that Phil Town teaches, that is, we call it the number one most important strategy, which is called stockpiling. You want to be extremely excited for times like this, which I am. Everybody's fear-mongering, Fox News fear-mongering, that's fine. You can do that, but you're not doing anybody any favors. You want to get excited, as Warren Buffett teaches us, when the market is fearful, you want to be greedy. So you want to be buying as much as you can right now. So right now, to be honest with you, I'm trying to scrape up every penny I can find on the street and put it into the market, because we know the average duration is 10 months. And as I'm telling people right now, this will give you good context. Trump Tariff War 1, as I call it, and I've got an article on Tykr that I'm labeling these. Some people are picking up the name, some people aren't, but there's Trump Tariff War 1, and now we have Trump Tariff War 2. 1 was September of 17 through March of 18, and that's when he started negotiations with China. Market went down 7%, and semiconductor stocks went down 30%. All right, so that year I made in 18, it was 80%, as I mentioned earlier. This year, I could see something similar. I'll probably make some very, very big returns because I'm buying right now. So there are people in the Tykr community that really appreciate me giving this information, giving the context of history. And what you do is you go into those on sale stocks. And we have a few other indicators that add more layers of confidence. For example, and I'll stop talking here in a second, we got a tool called the 4M Confidence Booster. What it does is it analyzes more than just the math. I'll give you the 4M's right now. So you have the math part, or the margin of safety is the first M. The second M is the business model. How many revenue streams does a business have, and how scalable are those revenue streams? The third M is the moat. How does a business compare to the competition? The last M is the management. The manual way of doing the 4M could take you hours, if not days of research. Well, we use OpenAI right now, and that reduces it down to seconds. So you can literally log in, see your 4M score. So if you're looking at that on sale and you're like, I'm not sure, look at the 4M score, because and you want an 80 out of 100 or higher. So I'm telling people, like, if you see the market falling, look for those high on sale stocks with a high 4M score. In most cases, I can't guarantee in every case, but in most cases, you're going to make a killing when the market takes off. And I historically, over the last 10 years, have done exactly that.
Wow. Now, where are you pulling this data from to begin with? Like, because you're obviously not, maybe some of it is manual, but obviously a lot of this is being pulled actively from somewhere to chop it up and analyze it.
Yeah, so like any financial institution, they're pulling from data providers, and I'll kind of go from their angle leading up to Tykr. So fortunately, publicly traded companies have, the financial statement, cash flow statement, and balance sheet. It's all public information. And then that is published to every quarter. You have your 10Qs, and then once a year, you have your 10Qs and 10Ks. It's all public information. Well, fortunately, we can subscribe to third-party platforms that aggregate all that data, all that public data, and then we pull it into Tykr. So we refresh the data in Tykr once a day, and we're refreshing, get this, probably several million data points per day. Like we've got I won't go too technically here, but a cron job pulling the data, and it's running. Think of it like you've got an 8-cylinder engine and you're going 150 miles an hour down the highway. It's running like that, like at high speed, pulling all the data into the tool. And if anything is missed, it does a double check to pull the data back in. So right now we have got 50,000 stocks. We're upgrading our data provider this summer, and we'll go to about 75,000 stocks, which will get us most stocks around the globe, and we'll get most ETFs around the globe, and we'll get about 10,000 mutual funds. So it's a huge upgrade. On top of that, we'll also get real-time pricing. Like the share prices today are once per day. But anyway, it's common practice to go to a data provider, that's their business model, and pull the raw data into Tykr, and then we do the analysis thereafter. It's a lot of complex software engineering. In my case, my engineering team and I find it very stimulating. It's pretty fun.
You're clearly a guy that loves the details, loves the nitty gritty, and to know as much as possible. And what's fascinating to me is last time we spoke, not too long ago, about your current capital raise for your business, and we can go into more of the details on that if you'd like. But when I was asking you some questions and when you were sharing some information about your business itself, so not about how Tykr operates for the customers, but how you actually manage the business and how you look at different metrics to see if your business is doing well. Like, you're extremely educated on that side of it as well as on the front end to help the customers. And so like
Mhm.
I'd like if you just could, I guess, share some of the different metrics and data points for, business owners or people that are looking to invest in private businesses. Like what are some of these metrics that we should be looking at to see how healthy our business is, how much it can grow, or what we should be looking at, these different things that you're already looking
Sure.
at for Tykr. If you could just elaborate on some of that.
Yeah, yeah. So, yeah, Tykr being a private business, and what I did, we're about 4.5 years old. I did not raise capital until now. The reason is, and this is a mistake I see a lot of people creating tech startups, especially in Silicon Valley, is they'll come up with an idea, go raise a bunch of capital. And the issue there is all the money or the majority of the money is being thrown at salaries. It's not being thrown into a machine that's $1 in, $2 back, or $1 in, $5 back. You want that cash flow machine, and that's where the money should be deployed. So I waited until we're nearing cash flow positive, which we're expected to hit this quarter, Q2 of 25. And this is really important. I'm going to get a few metrics here. Is a SaaS business, which is our model, software as a service. When you're nearing cash flow positive, that's a really exciting inflection point where investors are like, oh, nice. We're at that point where we can put in $1 and get $2 back. You want that. You want a money printing machine. In other words, too many startups out there, they raise all this capital. In fact, I'll go off on a quick tangent here and we'll bring us back to Centerpoint. But there were 3 other fintech platforms that started around the same time as Tykr. There are probably a few dozen more, but 3 that I knew. I became friends with the owners, and I told them all, keep your day job, which I did. I kept my day job for over 3 years while bootstrapping Tykr. It's not glamorous, but that's the way to do it. And they didn't listen to me. They quit their day jobs, raised a bunch of capital, and now all 3 of those businesses are out of business. You have to keep your day job near cash flow positive and then raise capital. So that's one metric, is where are you at cash flow positive? If you don't have cash flow positive, then you have burn. That's how much money, it's not your expenditures, but it's after expenditures and revenue. What's the number left over at that point? So a nice round number is, let's say your revenue is $10,000 and your expenditures are $12,000. That's a $2,000 negative number. That's your burn. So you want to get your burn as low as possible. And then when you hit cash flow positive, you don't have burn anymore. That's a beautiful place to be. So that's number 1. Number 2 is churn. Great book out there. Highly recommend. It's called T2D3. Really stands for triple 2 years, double 3 years. It's all about SaaS businesses. And the key metric they mention in there is if you can get your churn to 5.75% per month or less, that's really good. That's considered product market fit. So 2 years ago, we were at about 11%. Not
Can
very
you
good.
just pause real quick? Can you
Sure.
just elaborate on churn for people
Oh,
that
yeah.
aren't?
So churn is in subscription. It's, we'll use nice round numbers. Let's say you've got 100 people that join this, or you should say this month, and then 5 leave this month. That's 5%. So 5 of 100, 5% churn. That's what you want. You want really low churn. I phrase it as, you never want to be building a sinking ship. If you got, you got the ship, but it's constantly leaking, it's so much work to bring people in and then keep them. You want to make sure you've got a system in place so you can easily bring people in and then they stay. They're not leaving. And that takes a lot of work. You got to talk to your customers, do constant surveys, do Zoom calls, keep refining your product so you find out, why are people leaving, and ask them, what features are we missing? What can we do better? And we did that over the last 4.5 years to get our churn down. Wait for it. They'll give you the percentages here. So 2 years ago, we're at 11. A year ago, just over, we're at 6. So flirting with 5.75. Well, now averaging the last 12 months per month, we're at about 3.8. All right. Now people are staying. It only took over 4 years to get us there, but that's the point in time where, again, you want a business that's nearing cash flow positive and you can put money into it. So you're paying for people to join and stay, because I see too many businesses throwing all this money and their churn is 11%, 15%. It's like people are joining, but then they're going right out the back door. That's a bad business model. So that's another key metric. I'll give you, there's a few others too that we're really leaning into as engagement times. We've got a web app and mobile app. So the web app, get this, good for a SaaS, is a little over a minute. Tykr's average engagement time is about 8 minutes. On the mobile app, good for a mobile app, is over 5 minutes. We're over 20 minutes. So it's like not only people are they joining and staying, but they're using the app a lot. A basic metric that's going to win people over a lot, which is revenue growth rate. What is your revenue quarter over quarter? We're at a big inflection point with channel partners, those being brokers. So our revenue growth rate, just be transparent, it has not been huge. It's not like these big jumps, but the churn, the retention, nearing cash flow positive, those are the levers we're leaning into. And that has been enough to get our investors to jump on board. We know the revenue that's going to come. It's, you want to see the T2, D3 year over year, triple 2 years, double 3 years. That's hard to do, but I'm pretty confident we're going to hit that pretty soon. So
interesting. So I guess could you just elaborate a little bit more on the what was it?
T2, D3.
T2, D3. Yeah, like what does that mean in like kindergarten terms?
Yeah, okay. So there are certain business models that are highly, highly scalable. And since part of my job is analyzing stocks and understanding what those are, in my opinion, the three most scalable businesses out there are SaaS businesses. You also have ad tech. So think about businesses like Google, where people can put in their own credit card. A business can put in their credit card or debit card or multiple cards, and they'll keep spending money on their own. They're in control. They're controlling their spend. That's highly scalable. And then payment tech. So think about like companies like PayPal or Stripe or Plaid. They create a system and people are making transactions. And those type of businesses can go T2, D3. So kind of break that down. You want a business that can triple its revenue 2 years in a row and then double 3 years in a row. If you could triple 5 years in a row total, that'd be huge. That's hard to do. But, you know, the baseline there is go for triple 2 years, double 3 years. And that book, it mentions if your churn is at 3.5% or less, you are poised to be a T2, D3 business. That means you're getting a ton of people. Let's use a nice round number, 3% churn. You bring in 100 people in the month and only 3 leave. That is what you want. You keep adding people to the ecosystem and nobody's leaving, or very few are leaving. You can position yourself where all you have to do is do channel partners, which are aligning with businesses that promote your product. You can do Google ads, Facebook ads, YouTube ads. That's the printing machine you want. $1 in, $2 back, rinse and repeat all day.
And so that's the goal for you as the business owner, for the investors that you're trying to get to invest in your business. That's essentially a 5-year plan or goal. And somewhere along that path, you're raising capital. In this context, you waited a little bit longer than others, and it's interesting to hear the perspectives. Like you were saying, like some people, they have the idea, they're out raising money immediately, and then there's other people that will bootstrap and wait until it's at a point where investors can confidently invest, knowing, like you said, it's a cash producing business. So I guess just to sort of dive into those two perspectives a little bit more, I obviously know where you think it makes the most sense, but to speak to the people that are raising capital immediately, what I've seen is that some of those people, the reason that their business fails so quickly is because they're using it, like you were saying, for salary and for other things, and they're doing things in a different way than they would have done if they didn't have the money to begin with. So their mindset is actually just different from the beginning. They're not thinking about money constraints because they don't have the money constraints on the front end.
Right.
Whereas you would if you were bootstrapping. And I wonder, like, if you had to do everything over again with Tykr, is there anything that you would have done differently? Like now, maybe knowing that, like the mindset that you have now, is there a way for you to have successfully raised money earlier on in the process without it conflicting with how your mindset has worked thus far?
Good question. I actually would not have, but I've worked for my background. So you and your audience know, after 2010, I started to do corporate contracting. So I worked with quite a few public companies as well as private. Some of the larger companies I worked for include GE, which is public, and then another big one that's private is Kohler, both great companies. Learned a ton about how do big businesses really operate. And that really fine-tuned my knowledge of like, the income statement, cash flow statement, and balance sheet. Those quarterly earnings reports are so critical when you're on the inside and you're in a leadership position. It kind of was another aha moment in my world of investing. But anyway, I was part of a startup or two in the past. I did not found. I saw a lot of money being raised and thrown at salaries. Again, I don't love that strategy. I like raising capital put into immediate revenue generating activities and use the revenue to pay salaries. That's a lot safer on the business and it's a lot more capital efficient. So honestly, to answer your question, long story short, is keep your day job like I did and raise at the right time, which I feel I did. But again, I've seen the horror stories. I've seen the mistakes made, and there's an old saying out there, which is businesses don't fail, founders quit. And what that means is founders, they run out of cash flow. They don't have ways to pay their mortgage or their bills or do things in their life. And the simplest solution is swallow your pride and go get a day job. And if you do that from the beginning, your startup's going to be a lot better off. You got to be efficient with time. So you're going to work some nights and maybe some weekends. But I always, I would probably carve out when I was working the full-time job, I'd carve out 10 to 15 hours a week to work on Tykr. And then, making sure I'm providing the best value possible for my employer. So yeah, I wouldn't change a thing. I did it the right way, in my opinion. But again, I saw a lot of mistakes made from other businesses. So I kind of knew the roadmap ahead.
Okay, fair enough. And so a different question then based on your answer, when is it the right time to invest? Or I guess even put a different way, like how do you know if you should be raising money? Like should your business just operate and you're the sole owner and that's how it goes? Or like when would it make sense for a business to raise capital?
Yeah. Acceleration was my answer to that question. As I got to a point where I now know what customers are looking for. I now know what channel partners are identified as the best of the best. In this case, it's really helping brokers, and we're nearing cash flow positive. So I told myself I could either stay 100% owner and keep bootstrapping this, will be a longer timeline, or I can kind of strike while the iron's hot. Let's attack and let's bring on the right investors. So, I emailed our audience several times asking, hey, who in the Tykr community would like to invest? And fortunately, everybody that's invested, they have the right attitude. They're aligned with me. They know where we're going. They're letting me steer in the ship. However, there have been interviews with investors, angels as well as VCs, and there was not a good vibe there. I could just see personality-wise, they wanted to maybe control the ship a little bit. There was also devaluation strategies like, hey, your Tykr's valuation is at this. We'd like to bring it down to this and then invest this much to take 20-25% of the company. And I'm like, well, I'm not going to sell myself short. So that's a no for me. See ya. So you got to maintain, as I recommend to founders, is you need to maintain the high ground in that conversation. There's too many founders that they're in a necessity position. They have the low ground. They're asking for money. I need money. They'll do anything to get money. You don't want to do that. Maintain the high ground. You're going to be happier for the long term. And I've known investors or founders, I should say, that have taken that approach and they have a lot happier and more enjoyable journey building their startup, because there's a flip side of that coin, which is It's a pain in the ass building your business. And then if you do get acquired or sell, I've heard of situations, I see it all the time, where you sell and you'll make nothing because you've been diluted so much. And I'm like, yeah, I'm not going to make that mistake.
Got it. Yeah. Never raise out of necessity or desperation.
Right.
Raise to accelerate or scale. That makes sense.
Right.
Love that.
Yeah.
So, switching the parts of your brain, we're going from looking at investments, you're getting up to 80% returns in some years by utilizing the methods in Tykr. Now thinking as a private investor looking to invest in private business, what kind of returns should people be looking for? When when might it make sense for somebody to invest in a business? I know some people will simply invest because they like a brand, they're supporting it while also expecting some return, not necessarily caring as much about the return. Other people, they're, if it's not making X amount above and beyond what I could get in the stock market, there's absolutely no reason for me to do it. And so, where's the mindset there, at least that you're portraying to your potential investors?
Yeah, so the going rate, this is a nice benchmark for your audience to write down or at least make a mental note of. Venture capitalists are looking for, typically the going rate is between 10x and 30x over next 5 to 10 years. So we're telling our audience we're going for a 10x to 100x return as our goal, somewhere in that range over 5 to 10 years. If we sell to the right buyer, which we've identified as brokers, that's the journey we're on. Is yes, we help the retail investor, regular people like us, but the bigger play is actually helping brokers. So that's the number to think and keep in mind. And that, 10x to 30x outpaces the S&P 500 by a significant amount. To give you context there, what is it, about 80% S&P 500 returns about 80% over 5 years. Double that, okay, 160 over 10 years. That's all right. If you just want to be slow and steady, but you get the right private business to 10x. So you want to go, 100% to 1,000% returns is what you're looking for. And that's in the realm of possibility of private investments. And that's why we're not asking for big check sizes from our investors. We're going at this pretty lean. We have about 20 as we speak, investors with lower check sizes. And it's like, I tell them, like, hey, this is a private company. This is high risk. You can certainly go to the stock market, but if you're all in on this, and I almost do an anti-sell. This is kind of funny. Is like, I tell people, if there's even 1% of you that does not want to invest in Tykr, then don't. I'm not going to high pressure this to you. And they still invest. I'm like, all right, they're in. So, and I like that because I get pitched by other founders that are like, hey, invest in my business. They're begging for it. And nobody says that line. If there's 1% of you that does not want to invest, then don't. I'm like, I want to hear that line. I want to know you've got humility that, and you're not forcing the sale,
Yeah, absolutely. Now, what happens? So the goal is within 5 to 10 years to sell. It sounds like in your case to a broker. But what happens if you don't sell, right? Like, what happens if nobody wants to buy? That's just a reality. Then How does the business live on maybe after the 10 years, say?
Yeah, so we're telling our investors there's 3 ways they'll get paid. Number 1, the most glamorous way is, yes, getting acquired. Number 2 is we go public. That can be glamorous too, but that's an option. Or 3, we stay private and then our investors are paid a quarterly dividend. We essentially operate like a public company, but as the valuation of the company increases, their dividend continues to increase. So it's like getting a residual paycheck every 3 months. And all are great, and I love building Tykr. I've made so many friends around the globe because of the tool. It's like, this is what I want to do. And if, let's say, it never sells or goes public, I'm like, I'm still doing this. Like, and there's, in my opinion, I could talk about this on another podcast episode, but there's not a lot of people doing what we're doing and making it that easy. Sure, we have competitors. They do an okay job, but nobody, the traffic light rating is, you got to make things simple for people. And it's like, strike while the iron's hot. People aren't doing this. Let's do it. Let's do it right.
Good. I love everything that you've been saying. I appreciate all the the information and the details here. So I want to wrap it up, give you a chance to share with people more about how they can find out about you, about Tykr, and everything that you've got going on.
Yeah, so if people are interested in Tykr, we've got a 14-day free trial, no credit card, lowest barrier to entry as you can get. Get in, test drive it. As I tell people, test drive the car before you take it off the lot. If you like it, great. If not, no worries. And if people want to give it a test drive, you can go to tykr.com, tykr.com. And then another great location to connect with me is LinkedIn. Very active on the platform. So I try to keep it simple. 2 places to find me.
Perfect. All right. Well, I appreciate your time, Sean. This was really great. And we'll talk here soon.
All right. Thanks, Ian. We'll see
Thank
you.
you.